Hi there, Tim Clairmont here. Welcome to Clear Money Talk, where we turn complex financial topics into clear, practical insights.
I'm Tyler Andrews. Welcome to the show. Our question of the day for you listeners: should you sell your RSUs immediately?
Oof. Okay, boy, that is a tough one.
This is a heavy one.
Yeah. So, I suppose those who have clicked on this probably know what an RSU is, or if you clicked on it and you're like, what's an RSU? We should probably start there. RSU are restricted stock units. Is that correct? Is that fair?
That is correct.
Yep. Great, excellent. So a lot of people just call them RSUs all the time. But fundamentally, there are all kinds of different special ways of receiving stock when you work for companies that choose to share that stock with you. And there's different vesting schedules. There are different tax consequences associated with it. In general, I try to take a broad approach when it comes to stock. And I think the biggest thing that comes to me when I think about this is over-concentration. You've got to think about what percentage of your net worth is that stock portfolio. When you have one company that you have a lot of stock in, if you're overly concentrated in that one company, you have a higher degree of risk. And then I would say the second thing that comes to mind, and we can talk about where the line in the sand is for that. I'm sure that'll come up in this podcast. But the second thing that comes to mind is taxation is oftentimes a justification for retention. In other words, people say, oh, it's going to cost me more taxes if I sell it now versus if I sell it later. And while that is important and you do need to pay attention to the taxes, it is absolutely not a substitution for you when it comes to performance on the stock, especially if it represents a significant part of your portfolio. You need to think about performance first. So think of like category A, category B. Performance and the stock and your percentage of your net worth is the first priority, critical. Then once you've resolved that issue and how you feel about that situation, then you look at taxation second as a category B item. But that's what comes to mind for me. What are your thoughts?
Yeah, it's going to be a fun one. It's a very broad category, and when I say broad, it's also very niche too. So RSUs don't affect a lot of working Americans, right? It only affects those that have equity compensation as part of their overall compensation structure with their employer. But here's the vision. You're somebody that does have equity compensation. You have RSUs just vested. The shares of the company that you're working at hit your account. Now what? Do you sell immediately? Do you hold and you hope for better? Do you diversify? Do you wait for a better price to come around to postpone selling for that justification? And it's one of the most common questions that we get asked all the time from people in these industries. A lot of the times it comes from tech industries as they're cash-hungry organizations trying to grow. They don't have the cash deployable for higher income, so they a lot of times pay people in the form of equity compensation for retention and total comp structure and all that other stuff. But we're going to break down today how RSUs work, what they really are, how they're taxed, whether selling immediately actually makes sense, and how all that fits together for you and your situation. Now, this is going to be very broad information. Your situation is going to be very drastically different from the next person, but hopefully our goal today is to leave you more informed about RSUs and how they might work for you and if anybody has them. So.
Yep. No, that's great. Spot on.
Yep.
And actually, I rely heavily on Tyler as it relates to handling all of the RSUs within our firm and analyzing all of the elements associated with it and going into the details and reviewing all of that with the clients, because every RSU structure is a little bit different. Every client's feelings about their stock are a little bit different. Every client's over our level of concentration in that stock is different. And so as much as you might think that there are some black and white rules or rules of thumb that you should or shouldn't follow, the truth is it is very unique in every individual circumstance, and you need to give some consideration to that. But we'll tell you today some of the things you should think about as you're deciding what to do in your unique situation. So
that's right.
Yeah.
RSUs feel like an investment decision, but a lot of the times they're more of a compensation decision at the end of the day. So we'll talk through the nuances of that and how you think about them is going to determine what you should do next. If you are somebody that has RSUs or somebody that's about to come into RSUs, with your employer and how to make these decisions for you and your situation. So, Tim, let's first talk about what RSUs actually are.
Sure.
Which you started to hit on. I appreciate that. And I'd love to go back and forth with you on this stuff. But you hit it. RSU is just an acronym for restricted stock units. It's a form of compensation. They are a form of compensation that vests over time. So when I say that they vest, they usually are not yours immediately to do as you please with on day one. They're usually a promise from your employer that they're going to give you ownership in the company that you work at some predetermined event, whether that's a time event, you have to work here for X amount of years before these are yours, or if it's a goal for the company, you're going to come into these shares once the company hits this revenue milestone. There's these different events that can happen that trigger the vesting, or basically those shares becoming yours, and then it's in your camp to choose what you want to do with them at that point in time. Any thoughts on that, Tim, before I keep
Yeah,
going?
no, I think that what comes to mind for me is there's really three phases of having RSUs when you think about it. Phase one is you've received a bunch of stuff that you're not vested in. And there's not a lot you can do or maybe even need to do with it at that point. It's not yours yet. It's a promise of stuff that's coming your way later, and you probably want to pay attention to the stock and think about it. But the most important thing in general in our planning process is not to count on it. If you're not vested in it, you better have a good plan for everything else that you're trying to accomplish in life. Saving for kids' college if that's important to you, covering your own retirement expenses, handling things in a crisis situation. Are you going to be okay? Because if you lose that job, which there's a lot of job transitions that occur, whether it's voluntary or involuntary, but as soon as you lose that job, anything you're not vested in is pretty much gone. So if you're not vested in it in phase one, don't be counting on it. Phase two is where you've started to vest in some of it regularly. In other words, you have maybe a certain portion of this that is unvested, and then another portion that is vesting. And we have a lot of clients that come to us in that phase two part. And it gets a little challenging because you want to look at kind of two different layers. Imagine two buckets. One is the stuff you're already vested in. Two is the stuff you're not quite vested in yet, but you expect it to happen in the near future, and you have every intention and expectation of being around. A lot of times what we'll recommend is then it's time to start thinking about how much is the vested bucket as a percentage of your net worth. When you think about your net worth, think about the equity in your primary residence, think about any equity you own in any rental properties or investment properties. Again, I say equity, not gross value. So subtract your mortgage, it's just the equity position, net worth, right? Then think about the total combined investment portfolio that you have, your retirement accounts, all of your traditional investments. And then usually when you compare that vested RSUs to that overall total, in general, we try to avoid going over 10% in any one individual stock. It's a rule of thumb. It's not a requirement. But if you find that over 10% of your net worth is in any one stock, you're taking a lot of risk. And you're okay to take that risk if your net worth is so high in the other stuff that you're going to be okay if that stock goes belly up. Because we have seen stocks go belly up. We have seen clients who were over-positioned in one stock, and in spite of our advice to diversify, they didn't, or they didn't do it quickly enough. They kept thinking it was going to pop and go higher, and they ended up with less money. Now, the other part of it, though, is real. You could have FOMO, fear of missing out. If you diversify out of it too early, and you're constantly looking at how much it's grown and saying, well, if I'd left it in there, I would have got this, then you're going to beat yourself up and have that FOMO feeling, which is really painful. Anyway, point is, in phase two, you have to develop a disciplined strategy. How much are you going to retain in the stock? How much are you going to sell off regularly? And what are you going to do with the money that you sell off? If it is just a form of compensation, as Tyler was talking about, it makes it easier for you to look at it that way. Finally, phase three is where you've got most of your stock vested. You're looking at, this is a significant part of your net worth, and whether that represents less than 10% or much more than 10%, now you have to figure out a tax-efficient way to divest yourself of that. And we have a lot of strategies for clients that end up in that situation too. Sometimes that can happen really suddenly. For example, if you think about NVIDIA stock and what happened to that in the last few years, you might have had a large amount of RSUs that you were sitting on, and then all of a sudden the stock went up so much, it became a much larger part of your overall portfolio and your net worth. And now you're highly overconcentrated because of how successful it was. And you're looking at it and going, wow, should I hang on to that or not? I mean, things still look good. What if it keeps growing? And that greed factor comes in. So you have to balance greed versus wisdom. And there's not a right or wrong here. I mean, I understand the word greed itself comes with this feeling of guilt or wrongness, and I'm not trying to go there. I'm just trying to say that that's a human emotion to say, I think this might be worth more later, or maybe I should hang on to it. You just have to decide if you can afford to hang on to it. So those three phases are a couple of the ways we look at it. And if you're in phase one, just see that phase two and phase three are hopefully coming if you keep your job and we see some nice growth in your particular RSU.
We want that for everybody. If you are somebody that has RSUs, we want that to continue to be a fruitful event for you, you know, both short-term and long-term. But like Tim mentioned, the two biggest reasons I would say that people have conflict when it comes to RSUs is the taxation and then also the future appreciation potential of that stock position. So let's talk about taxes really quick. Tim, I know you love taxes. So let's get into the nitty-gritty of how the taxes work in RSUs, because sometimes it's not as complicated as it sounds, but sometimes it gets overcomplicated. So RSUs are, like I said earlier, just a form of compensation. So when they vest, the value of the shares on that day that they vest is taxable to you as ordinary income. So it's as simple as that. So it's still subject to your federal and state income tax thresholds, still subject to FICA taxes, so Social Security, Medicare, and other taxes like that. So it's basically as if you got a cash bonus from your employer, but in the form of equity compensation. And that is a great way to frame the conversation. You know, once they vest, the taxes already happened. You owe the tax at that point in time. So the only question that is left is the investment strategy.
That's right.
Are you going to retain the stock or are you not going to retain the stock? And that's where we get into the case of the whole podcast. Should you sell them immediately or not? And that's what we'll talk about here shortly. But framing the taxation of them is important, so that way some people try to hold on to that as a justification to do one thing or another. But if it's going to vest and you're going to owe the tax immediately anyways, then it becomes an easier conversation of, okay, now what do I do with the stock now that I've already paid the tax on it and that it's mine? Mm-hmm. So that's what we'll go next here, but please.
Yeah, no, it's well said, Tyler. Once you've paid the tax, so let's take that NVIDIA example again. If somebody received stock from NVIDIA 4 or 5 years ago, then they had to pay taxes on it, but they hung on to the stock, and then the stock went up so much that now if they sell it, the difference between what it was worth when they received it and paid the taxes on it versus what it's worth today, there's a huge gap, and that gap, you will get hit with taxes on that. And if you've held the shares for over a year, you can be long-term capital gains taxes. Plus, if you're in a state that has a state income tax, don't forget you're going to get hit with the state income tax on that as well. Alternatively, if you reposition yourself out of that portfolio right away, you might have missed out on that growth, but you could also miss out on the loss that could otherwise occur. So one question that we encourage clients to think about when they receive their stock and they vest in it and they have to pay the taxes on it at that point is, if you had this cash today with this after-tax money, would you buy this stock with that cash? Mm-hmm. Because if you had received the compensation as cash and you were then going to pay the taxes on it and everything else, would you have used the cash to buy the stock? If the answer comes back yes, you should probably hang on to that stock and go ahead and do that, and as long as it makes sense in your overall portfolio. If the answer to that's no, then you're probably going to be more likely to be the individual who sells the stock shortly after they vest and pay the taxes on it and just turn that compensation into cash, and then you can do whatever you want with it at that point.
I'm so happy that you said that quote. If you could remove all the external factors from the event and just say, if you had cash, would you still purchase this thing? I think that's such a constructive way of looking at it. So I'm happy you brought that up. All right, we're going to do a speed round here, Tim. We're going to go through the case for selling immediately. I'm going to hit you with some things. I just want you to share your quick thoughts on each of them. And then we're going to go through the case for holding, which is the opposite end of that. So that way our listeners that maybe have RSUs or have concentrated stock positions can hear both cases, one for selling immediately and one for retaining. The case for selling immediately.
Sure.
You ready?
Yep.
Okay, it reduces concentration risk.
Yeah, that's key. Again, I think a good rule of thumb is 10% of your net. Let's say if your net worth is below $5 million, 10% of your net worth is a good number for you to consider. And this is in today's day and age. I mean, it's 2026 when we're recording this. If you watch this in 2300 or something like that, 5 million is probably going to change. But the point is, for today, I'd say 5 million. If you have a portfolio net worth of that size or less, 10% is a good number to think about as a good diversification, maximum for over concentration.
Yep, I like it. It helps avoid emotional attachment.
Mm-hmm. Yeah.
I think the longer you hold on to something, the more you get attached to it.
That's right.
Regardless, if you own a car for 20 years, it's hard for you to sell that car. You're like, that's been with me through a lot of ups and downs in different parts of my life. So it's easier to say, I'm just going to hold on to it because we have so much history. But same thing can be said for a stock. If you have a lot of history with it, you're likely more inclined to want to hang on to it because change is inevitable, but also change is uncomfortable. So if you can just rip the Band-Aid, get it done sooner, it might help to remove that emotional attachment aspect of it. Another case for selling immediately, Tim, helps align your portfolio with a target allocation.
Yep. Yeah, when you think about the performance of that individual security as an asset, it's anomalous compared to the diversified portfolio that you might otherwise have. And integrating that performance of that individual company into your overall portfolio and factoring in what that looks like might be a lot more challenging than simply selling it and diversifying the asset itself into something that is more representative of a prudent allocation.
Yep. And then the last one, Tim, another case for selling immediately is it helps to treat the compensation more like a cash bonus opposed to equity.
Yeah, I would say that's mentally consistent. It's funny. I was thinking of another analogy here, as I'm an analogy junkie. Imagine that you have a normal job and you don't have RSUs, and you get $100,000 of income coming in. You got to pay taxes on it and so on. Then you live on that. And now you have another job where you get $80,000 of income, but you get $20,000 worth of these RSUs. Now imagine that the RSUs were like eggs from the golden goose, the goose that's going to lay these golden eggs. So if the RSUs were gold eggs that you got at this $20,000 value, when you vest and have to pay taxes on them, you got to pay taxes on that $20K, the same as the person who made $100,000. And if they're really gold eggs, and gold has gone up as much as it has in the last couple of years, you might have some significant increase in the value of the eggs, and you get emotionally attached to the eggs. They look different, they feel different. I'm hanging on to these eggs. Look at how cool they are, and then they get higher in value. And maybe you sell the eggs, and maybe you don't sell the eggs, but you're struggling, and you're like, I've got 5 eggs today. Maybe I sell 1 and keep the other 4. But then what if that one that I sold would have been worth more? And you start to have FOMO. The problem is that we've also seen the scenario where they're literally eggs and not gold eggs. They're hollow eggs. I have a client who was an employee of PGE up here locally, and you think about Portland, Vancouver area, and they had a significant disproportionate amount of eggs that were in Enron stock. And we told them to sell and diversify before the Enron situation blew up. They didn't. They chose not to, and it represented over 60% of their net worth. And they watched those eggs essentially drop in value so drastically that they were virtually worthless. They were hollow shells of an egg. We don't know if you have a gold egg, or if you have a hollow shell egg, or if you have something in between. We don't want to speculate on that. Frankly, you may know more about that company and what it's likely to do in the future than we do, especially if you're an insider, and then you have some other complications as well, because you can't trade on insider knowledge. You can only trade on public knowledge, and there's some other restrictions that come into play. But the point is, you're going to have to make that call. Only you know if you think this is a gold egg, or if you think it's a hollow egg, or somewhere in between. And having a good disciplined approach where you say, this is what I'm going to do with these eggs, is the key. Take the emotion out of it.
Yep. That's great. All right, next time, another speed round here.
Speed round,
the case
right.
for holding. So
Right.
retaining the stock, which you already mentioned some really good stuff, but strong conviction in the company growth.
Yeah,
right?
yeah. You might have a private company opportunity where you have equity. It's not even publicly traded, and you own and you're vested in that stock, and potentially you think that stock is going to be worth a lot of money, and frankly, there's no other way to get it. People can't just buy it. It's really unique. And if it's that unique, you might really want to hang on to that. Just make sure you can afford to take that amount of risk.
Yep. Another case for holding is tax planning considerations. Yes, we talked about how the taxation happens regardless of your decision when they vest, but what happens after they vest? What happens after you've already paid the ordinary income taxes on it? Well, they can go up in value. They can also go down in value. Those are opportunities for capital gains and capital losses, and you can tie that into your broader financial planning strategy if it makes sense for you from a strategic planning standpoint. So another case for holding, depending on your situation.
Well said. I got nothing to add to that.
Yep, and that ties into another case for holding is long-term capital gain strategy. So if you hold an investment for less than a year and you sell it at a gain, it's oftentimes taxed at ordinary income tax rates because Uncle Sam, the IRS, and the federal government wants to incentivize long-term investing for us Americans. So they incentivize people to hold something longer than 12 months. You can tax more preferentially on gains at that point, long-term capital gains versus short-term capital gains there.
Well said as well.
And another thing that Tim, you mentioned already, another case for holding is inside knowledge of company trajectory, as far as the moving forward with that is concerned.
Yeah, that's right. If you have insider knowledge and you can't get hit with insider trading, you can't. You're at risk for that. So you want to avoid that. Is my point. You're not going to get in trouble for holding an asset you've already been given. You're in trouble for buying or selling, hence trading. Insider trading is buying or selling the asset. If you've already received the assets as part of an RSU process and you choose to hold the assets because you think that there's a great opportunity that's coming and the stock's going to go up a lot, then that's on you to make that decision. That's you judging the egg and saying, this is not a hollow egg. This looks like a gold egg or maybe a platinum egg or something even better. And fundamentally, that's your right and your decision to make that choice. It's just sometimes you're wrong. Sometimes what you think is going to happen doesn't happen, and even knowing as much as you might know that it doesn't always go the way you think it's going to go. So you always want to have a plan B in place where you're going to be okay. And then if you are an insider and you do decide you want to sell, you have to be very careful with how you do that. You got to dot the I's, cross the T's, and do what it is that you're supposed to do, and make sure it's not on any kind of non-public information. You're making a decision based on what's available to the public at that time.
That's right. Yeah. I want to reframe this too. Holding is not wrong.
Mm-hmm. No.
But I think it should be intentional.
Yes, I agree.
So as long
Absolutely.
as you understand the pros, the cons, the upside, the downside potential for what you're doing in your situation, that's important. But if you don't know and you're like, I'm just holding on to this thing because I don't know what else to do,
Yeah.
I think that's where it presents a lot of risk.
And 9 out of 10 people that we talk to, they're in that camp. They're not in the intentional camp. They're in the, I just didn't know what to do, and I'm sitting on these things. That's what they say when they come and see us, and then we have to develop a plan together and make some decisions and let them know. But we can't have them upset with us if we say, you should probably diversify this and sell this, and then they sell it, and then they pay the taxes, and then it goes through the roof. Again, imagine if you had been given that advice by a financial advisor 3 years ago and you were overly concentrated in NVIDIA stock. It would have been an extremely reasonable thing to say, hey, you should probably go ahead and look at selling some of this stock to diversify your portfolio. You're overly concentrated. And yet, had you held those shares for another couple of years, you could have seen the phenomenal return that we experienced just a couple of years ago. I mean, I think it was over 1,000% 1 year. It was crazy.
It's up a lot.
Yeah,
I think so. We're using that as an example because it is so mainstream, right?
That's right. That's right. That's the reason for the. And I don't know what's going to happen. I mean, shoot, it could go through the floor in 6 months. By the time this podcast pops, it might. You have no idea.
That's right.
I'm not predicting future positive or negative performance on NVIDIA. Just as an example, if you then blamed your financial advisor for that advice to diversify in a prudent allocation because you didn't get that growth, or you blame yourself and feel horrible FOMO for the rest of your life, that's a real risk. You have to anticipate that could happen. But just as easily, you could end up with that Enron situation as well. And if you don't do it and you hold it, and you end up with a hollow egg. So it's an aggressive speculative position, and that's why we usually recommend less than 10% of your investable net worth.
Yep. Yeah, when it comes to RSUs, the default emotional response is often, I'll hold, and I hope it goes up in value. But the more strategic question should be, what role does this play in my overall portfolio, my overall short-term and long-term financial goals?
Yep.
And RSUs shouldn't be about loyalty to your company. Like, I have to hold on to these because I'm loyal to my company. They've done so much for me, and I'm going to try to work here forever, so I'm going to hold the stock. But it needs to be more along the lines of, is this right for me and my financial goals? So reframing the question that way can hopefully help to reframe your perspective if you're somebody that's holding a lot of RSUs or in a situation where you're going to have to start making decisions about RSUs.
That's right.
Yeah.
And pay attention as well. If you have a significant amount of RSUs that have appreciated and you're going to have a big long-term capital gain, there is a consequence if the total income that you earn in that year with the capital gains goes above a certain threshold, you'll be paying 20% instead of 15% long-term capital gains taxes. So paying attention to where that's at and possibly divesting your larger portfolio over a couple of years might make good tax sense, but it has to make good investment sense first. So you've got to give that good consideration as you're taking a look at that overall mix. And if you're going to relocate to a tax-free state, for example, we have a lot of clients here in Oregon or clients that are in California. If you're planning on retiring and relocating to Washington or Nevada or Texas or Florida or Tennessee where there's no state income tax, just moving into one of those other states and then selling your RSUs can avoid the state income tax hit that would have otherwise happened on all of that gain, which is 9 to 10% in Oregon and California. So, I mean, that's not an insignificant number. That's a very large number if that's one of the things you were anticipating doing in your planning.
Yeah. And I feel like a lot of people might be moving more to Florida now, because I just read
Florida
that they
too.
also got rid of property taxes recently. Which,
The tax havens.
yeah.
Yeah.
Anyways, should we jump in just the answer, Tim?
Yeah, let's go for it. Good luck. That sounds good.
We're going to do just the answer for you. As always, we recommend listening to the full version of the podcast for all the valuable insights that Tim and I had to share, and also the fun that we had to share as well. It's always worthwhile. But for the people that just want the bottom line answer, our topic was, should you sell your RSUs immediately? Tim and I talked about really three separate things here for just the answer part of this that are worth thinking about. Taxation. So RSUs have inherent taxes associated with them, both income taxes when they vest, and also long-term capital gains taxes potential if they go up in value. Also potential long-term capital gains losses, or short-term, or vice versa. So taxes are often a huge critical component to RSUs and the decisions that follow those. The other thing we talked about was concentration risk. I think this is one of the other biggest things that people talk about with RSUs, is if you're working at a company that has part of your equity compensation in the form of stock, a lot of the times that stock accumulates, and it can accumulate sometimes fast depending on your situation and your company and other factors. And if that's the case, your stock position in that company might become a huge portion of your overall net worth quickly. And if that happens, you need to step back and say, is this what I wanted to happen? Is this intentional? Is this prudent given my risk tolerance, my time horizon, and other factors? And not just let it happen because you don't want to make a decision, whether hard or an easy decision. So concentration is another thing. Tim, I want to rephrase the question that you mentioned earlier, which I think is so powerful, is that let's reframe it from not just RSUs, but bonuses, which essentially RSUs are a form of bonus. If your employer was paying you cash instead of stock, would you still be purchasing that stock? And I think that's the right question to ask for this podcast when it comes to should you sell your RSUs immediately or not, is if you had the cash instead of the RSUs, would you still be purchasing the stock, or would you have a total different plan in mind?
Yep.
If you can answer that question confidently, it can hopefully lead you to the answer of the podcast here.
Yeah, and I would say that the biggest thing is performance of the stock is prioritized above taxation. Don't let taxation, it's like the tail wagging the dog. Don't let taxation be the reason you hang on to a particular position. Mm-hmm. You need to make sure that your allocation in that portfolio or in that stock is something you feel good about, and avoid that over-concentration risk. We also shared 10% is a good rule of thumb if your net worth is below $5 million. If your net worth is at $10 million or above, you can afford to take a little bit greater risk. You might be able to say, hey, I'm going to put 50% of my portfolio in this stock because if I'm worth $10 million and I lose 5 of it, I can still live on the other 5. That's not an unreasonable decision to make. You can do that when you have higher net worth and exceed that 10% level. But everybody below 5, generally speaking, you need most of that to just do the basic things that most of us want to do: retire, take care of our family. If we want to leave a little bit behind, that's usually $5 million or less kind of stuff. And when you're above 5, you got the 10 or the 20 or the 30 or the 50 million or other. The rules of thumb change for you, and the taxation changes as well. We have to give consideration to that too. Though even in that scenario, performance trumps taxation.
Love it. Ready for some trivia, Tim?
Yep, let's go.
All right. Tim, I'd like you to tell me what percentage of a typical executive's net worth is often tied to a company stock at peak concentration.
At peak concentration, wow.
Okay. I'm going to give you some numbers.
Yeah, go
here.
for it, man. That's
Option
an interesting
A
question.
is around 10%.
Okay.
Option B is around 25%. Option C is around 50%. Option D is over 70%.
Is it an average executive?
Yeah. A typical executive's net worth tied to a company stock at peak concentration.
Peak concentration, wow. I'm going to go with a typical executive. There's if they factor in the executives that don't get any stock, because there are a lot of executives that don't receive any stock at all, it's going to bring down that average. So I would have said 10% if they're factoring in all the executives that are not getting any stock at all. I would think that's probably about right.
The big tech companies, Tim.
But I would say realistically, 25 feels more likely for an average. I get the tech companies have a lot larger concentration positions, and maybe that's exactly why we're doing this podcast. Now, gosh, if 70% is the right answer, there's a lot of people we need to help. So I'll go with 25, but yeah, tell me the truth.
The truth is, there's a lot of people we need to help.
Oh my
because
goodness!
It's,
Holy cow!
Over 70%. So
Holy cow! What are you guys doing? you need to talk to us. That's crazy. Like, I mean, it's not. Maybe it's not great. Well, maybe your net worth is well above the $5 million level, and you're at 10 or 20 or 50 or 100 or $300 million or something like that. And you can afford to take bets like that. But if your net worth's below 20, I can't see you going over 50% in it. That's a big bet. It's a very big bet.
Yeah, concentration's not just hypothetical, it's common, which is why this podcast and this question is so important.
There you go.
Always fun to tie it back one way or another there.
Well, thank you very much for joining us on Clear Money Talk today. We hope you got some good insights regarding RSUs and the implications associated with them, how to look at them a little differently. And we always appreciate your minutes.
Absolutely. If you found value, please consider subscribing, sharing it with a loved one, a friend, a coworker, a family member, a neighbor, anything. Run into somebody on the street, share it with them. We're having fun growing this community. We're having fun doing it with all of you. So we appreciate you tuning in for an episode week over week. And we look forward to future ones here to come soon.
Thank you.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities through Ceteri Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Ceteri Investment Advisors, LLC, a registered investment advisor. Ceteri is under separate ownership from any other named entity. The views depicted in this material are for informational purposes only and are not necessarily those of Ceteri Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Ceteri Wealth Services exclusively provides investment products and services through its representatives. Although Ceteri does not provide tax or legal advice or supervise tax, accounting, or legal services, Ceteri representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. A diversified portfolio does not assure a profit or protect against loss in a declining market. This is for informational purposes only. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.